In this video, I will attempt to explain a three-line investment strategy using the financial markets. So, here we have the base of a graph showing the growth axis in the vertical line and the timeline axis in the horizontal line. The black line represents the historical market trend since the beginning of time. Each investment line fluctuates depending on the underlying funds that are chosen in that category. In my example, you will see the cautious line in orange. It doesn't fluctuate a lot because we have chosen a low equity component. And depending on the client and their risk tolerance, these percentages could vary greatly. But as they stand, this section will give the client immediate income with a benchmark of 2% above inflation and aimed at 1 to 3 years of required cash flow income. The next line represents the moderate line in blue, and it fluctuates more than the cautious line. This will not be used to produce an income stream, but rather serve as a backup should the client require extra capital. In our model, we have chosen 45% equity and 55% interest, or debt instruments as they're called in the market. With a benchmark of 4% above inflation, this money will only be needed within the next 3 to 10 years. And then the last line in green is the aggressive category. It fluctuates across the historical trend line quite vigorously, as you can see. However, with a long enough timeline horizon, it is here that the portfolio has potential for real growth. With a benchmark of 6% above inflation, the asset mix is 70% in equities and 30% in debt or interest funds. This money can be left alone to grow because it won't be needed for the next 8 to 15 years. This fund line is earmarked for the long-term growth and legacy planning. The secret weapon when using this type of investment is rebalancing, and you need to do it at least once a year. I've placed my fictional 1-year annual rebalancing timeline at random, so let's see what we can learn from this exercise. The aggressive green line has grown very nicely. The growth for the yellow income producing line has broken even in this graphic example, and the blue line has lost value. It's way beneath the trend line, which means that units have lost value in this cycle, and as we rebalance, selling some units in the aggressive fund at a profit and buying units at a bargain price in the moderate fund just before they rise again creates an advantage for the investor. So let's take a look at some numbers to get a better understanding. Let's say my client has 4.8 million in total, and we've agreed to invest in the three-line strategy: 20% cautious, 20% moderate, and 60% aggressive. Or in this case, 960,000 Rand cautious, 960,000 Rand moderate, and 2.88 million Rand in the aggressive funds. The client needs 25,000 Rand a month, 300,000 Rand per annum as an income. So 300,000 Rand funds are drawn from the cautious line, reducing the fund down to 660,000. The moderate line investment units are down by 6.25%, but the aggressive units are up in their cycle by 15% in our model illustration. So the green column in the table shows us what the funds look like after 1 year before rebalancing, and the orange column shows the values after rebalancing. Rebalancing enables the client to take advantage of the market fluctuations to gain growth, without having to time the market or second guess fund managers and asset mixes. In this example, in spite of the fact that the client withdrew 300,000 Rand from their cautious invested category, after rebalancing, the overall capital is still positive. If you would like to explore these concepts in relation to your own investments, visit us at snapshot.co.za, that's snapshot with a double P, double T, and use the free calculators. Or you can register and we will introduce you to a financial advisor with the relevant skills to assist you.